Everyone has to live somewhere, and everyone has to invest their money someplace. So what happens when where you live meets up with where your money is invested? Hello, real estate. Welcome back to Big Money Real Estate. I'm Ilyce. Here's your daily update. So RealtyTrac just came out with its U.S. foreclosure market reports for the first quarter and for March of this year. They do these things quarterly and monthly. The data was mixed, and the first quarter showed the lowest level of foreclosures nationally since the first quarter of 2007, when this whole fun circus began. That marked a year-over-year decrease of 8% and a 7% decline from the fourth quarter of 2014. The numbers for March moved in the opposite direction, and that's not such great news. While there were just over 313,000 foreclosure filings for the quarter, which is great, March alone saw more than 122,000 filings, and that's a 20% increase from February. February had seen the lowest foreclosure numbers in 8 years. March's total is a 4% increase from the same time over last year, 2014, and that marked the first year-over-year increase since September of 2010. So that's a lot of numbers to throw your way, but the bottom line is we're moving in the wrong direction. What's causing this? According to RealtyTrac, the increase was driven primarily by a 17-month high in bank repossessions, right? So banks are taking back properties. And while any increases in foreclosure numbers can seem scary after what we've been through the last 8 years, our friend Darren Bloomquist at RealtyTrac believes that this is just an indication of some stubborn foreclosure cases that are finally getting flushed through the system. And the first-time foreclosure numbers support that perspective, as they were down 8% from the previous year and 11% from the last quarter of 2014. Now, as always, there are some locations where the numbers run counter to the national trend. First quarter foreclosures were up some 58% in Massachusetts, 11% in Virginia and Michigan, and 8% in Illinois. First quarter bank repossessions increased 54% year over year in Ohio, 39% in Maryland, 34% in Missouri, 18% in New Jersey, 16% in Illinois. Who had the most foreclosures? Well, Florida, same as always, Illinois, Maryland, Nevada, and New Jersey are the states with the highest first quarter foreclosure rates. Of those, I would say to you that Maryland is one that is a little bit new to the game, and New Jersey as well. But Florida, Illinois, Nevada, we've been seeing those for the last 8 years. Now, for metro areas with a population above 200,000, the highest foreclosure rates were found in Atlantic City, New Jersey, Rockford, Illinois, Ocala, Florida, Lakeland, Winter Haven, Florida, and Miami, Florida. So big Florida contingency. It took an average of 620 days to complete the foreclosure process for properties in the first quarter of 2015. That was up from 604 days the previous quarter and 572 days the prior year. It is down, however, from 1,000 days plus, believe it or not, that it was taking in some of the judicial foreclosure states at the height of the recession. The states where it took the longest to complete foreclosures, ending in the first quarter, were New Jersey, where it took an average of 1,115 days, Florida, where it took an average of 975 days, Hawaii, where foreclosures took an average of 1,058 days, Kansas City, where it took 963 days on average, and finally New York, where foreclosure took an average time to complete of 1,475 days. Whew. That's over 4 years, including the leap year. Thanks for watching this episode of Big Money Real Estate. Send me your real estate investing questions on Twitter and Facebook, and be sure to share this video on social media. Until next time, I'm Ilyce.